In the last 48 hours, the price of silver crashed 19%. The mainstream narrative is one of market weakness. That is the story they are telling you. Now, here is the data from the physical market. As of this Monday, another 1.5 million ounces of physical silver were just removed from the COMEX registered stockpiles, pushing the entire deliverable inventory down to a critical 78.48 million ounces. The paper market and the physical market are telling two completely different stories. In fact, they are the most disconnected they have ever been. To understand precisely how this happened and what it means for the immediate future, you need a framework. We call it the Decoupling Doctrine. So, how can a price crash while the underlying asset is disappearing? To make sense of this, we need a framework. We call it the Decoupling Doctrine. The Decoupling Doctrine is the analytical lens we'll use to separate physical data from paper prices and to test which market is telling the truth. Think of it as a 4-pillar dashboard for tracking decoupling. First, the COMEX bleed. We track the drain of physical silver from the vault system behind silver price discovery and delivery. Second, the China factor. We dissect unprecedented physical demand signals from the Shanghai Futures Exchange that Western pricing ignores. Third, the professional's dashboard. We read the indicators bullion desks track, lease rates, and backwardation to gauge stress in physical availability and delivery risk hidden in the paper market. And finally, the long game. We map scenarios by projecting depletion and demand trends to see where divergence between paper and physical is forced to resolve. Let's begin with the vaults. The COMEX, the heart of the Western paper silver market, is hemorrhaging physical metal. This isn't a slow leak. It's an accelerating drain that exposes how thin the real backstop has become ahead of the April 30th delivery window for the May contract. Start with the vault data. In just 22 trading days, deliverable registered inventory fell from 102.2 million ounces to under 88 million. That is roughly 14 million ounces gone, about 1/7 of the entire stack, in essentially a single month. A drain rate of nearly 650,000 ounces per trading day. If we simply repeat another block of 20 trading days at that pace between now and the April 30th window, that is another 14 million ounces stripped out, pushing registered down toward the mid-70 million ounce range just as May delivery decisions lock in. None of this is theoretical. It is happening in the data right now. Now, layer on the current delivery behavior. The recent March delivery cycle saw over 10,406 contracts stand for delivery. That represents a demand for over 52 million ounces of silver. Set that against a registered pool now below 88 million ounces. 1 month's deliveries alone are trying to pull well over half of the entire supposedly available pile. COMEX settlement data flagged this March pace as running at multiples of prior modern delivery cycles, not a routine month. Every ounce that walks out in March is one less ounce available when that April 30th May delivery window opens. This is the market choosing metal, not cash, and it is doing it while the inventory base is already sliding. But March is only the warm-up. The real forcing function is the upcoming May futures contract that rolls into its delivery window on April 30th. For May, open interest currently sits above 80,000 contracts. Using CME's own figures, that represents about 1.4 million ounces of paper claims on silver. Let that number sit, more than 400 million ounces of claims stacked against less than 88 million ounces of registered metal, roughly a 5-to-1 mismatch, before any further drawdown between now and April 30th. Remember how this market is supposed to work.
COMEX is designed on the assumption that most participants roll their contracts forward or close them out before delivery.
Only a minority usually stands for metal. That assumption is what allows a 401 million ounce paper pile to sit on top of a sub 100 million ounce physical base without immediate crisis. The problem is that recent behaviour is chipping away at that assumption. Look back to January. In that delivery cycle, delivery rates approached 62%, meaning well over half the contracts eligible for delivery actually stood and demanded metal. In a market where, historically, only a minority of contracts actually take metal, a 62% stand rate is a clear outlier. You do not need another 62% event in May to stress this system. You do not even need anything close. When we run 10-25% delivery scenarios for May, we are deliberately dialing that January behaviour down to a much more conservative range. This is where the countdown to April 30 becomes simple, visual arithmetic. Take that 401.4 million ounces of May, open interest, and run a few conservative scenarios against a registered pool under 88 million ounces. Scenario 1. Only 10% of May contracts stand for delivery. That is roughly 8,000 contracts claiming about 40 million ounces. Call it 46% of the entire registered inventory. Nearly half the pile gone from just one contract month before any new metal comes in. Step that to 15%, now you are talking about around 12,000 contracts and roughly 60 million ounces demanded. That is more than 2/3 of registered inventory removed. The bar on the screen would already be mostly empty. At 20%, about 16,000 contracts would be standing, representing roughly 80 million ounces. That is 91% of the registered stack spoken for. What was supposed to be a buffer is effectively exhausted. There is almost no metal left to accommodate late arriving demand, short covering, or any additional draw outside COMEX. Now push it to the true breaking point in this setup. Us 25%. A quarter of May, open interest choosing delivery would represent just over 20,000 contracts and more than 100 million ounces of silver demanded. The math now asks for over 100 million ounces from a registered pool that, even before further drawdown, sits under 88 million. You have claims for metal that simply is not sitting in the deliverable category. At that point, something has to give. The exchange can try to coax metal out of eligible storage and reclassify it as registered. It can lean harder on exchange for physical mechanisms, or it can incentivize cash settlement. Those are the usual pressure valves, but none of them change the underlying reality. A 25% delivery rate on the current May, open interest implies physical obligations well in excess of the immediately available registered stock. That is not an abstract worry. It is what the basic arithmetic shows if even a quarter of today's paper claims insist on metal into the April 30th window. Notice how conservative that stress test is. January's delivery rate, near 62%, is more than double the 25% threshold that mathematically overruns registered. Even if May behaves far more moderately, say in the 15-20% range, you are still draining 2/3 to more than 90% of the registered pile at precisely the moment the daily vault bleed is already eating into it. The system is not broken in the sense of an immediate legal default, but it is being pushed into a corner where rule changes, reclassifications, and off-exchange settlement become the only way to muddle through. Thread all of this back to the calendar. Between now and April 30th, every day of 650,000 ounce outflows, every contract that chooses to stand in March, and every May position that refuses to roll is tightening the noose on that sub-88 million ounce registered pool. None of this is resolved until we see how many of those May claims
actually step across the line on April 30th and demand metal instead of paper. So, which of these signals do you find most critical? The plunging registered inventory, the massive May open interest, or the record-breaking delivery pace we are already seeing? Let me know which one stands out to you in the comments below, because the pressure on COMEX is not happening in a vacuum. A far larger force is pulling this metal out of Western vaults. A sustained, strategic bid for physical originating in the East. To understand where this goes next, you have to see how that external gravity is reshaping the entire flow of silver. What's happening is that China is treating silver not as a commodity, but as a strategic national asset. The COMEX crisis is not an isolated event. It's being systemically amplified by a strategic player that has recognized its own internal supply crunch and is now taking decisive action. This is not speculation. This is official policy. The Chinese government, facing its own dwindling stockpiles, has systematically begun to hoard its domestic supply and choke off exports to the rest of the world. Imagine one of the world's biggest supermarkets suddenly announcing it would no longer sell bottled water to its neighbours because its own town's reservoir was running dry. That is precisely what China is now doing with silver, and it makes the drought everywhere else that much more severe. Here is the mechanism. In January of 2026, as reported by Reuters, China's Ministry of Commerce, or MOFCOM, implemented a strict silver export licensing regime. For the entire 2026 to 2027 period, only 44 companies were approved to export. In an economy with thousands of industrial users of silver, restricting export rights to a small state-approved list is a sharp tightening of the outbound flow. A major tap of physical silver that the Western world has relied on for years was effectively turned off at the source. This is a sovereign state acting on physical scarcity, completely ignoring the signal from the paper price, and China is not some marginal participant. It is one of the central hubs of both silver production and, more importantly, silver consumption. Its factories sit at the heart of global solar panel manufacturing, electric vehicle supply chains, consumer electronics, and a growing list of defense and high-tech applications. When Beijing prioritizes those sectors and decides that domestic fabrication takes precedence over satisfying foreign demand, that decision doesn't just rearrange a trade statistic. It redirects metal that used to leak out to the rest of the world back into Chinese industry, tightening the screws on Western buyers. For Western industrial users and for COMEX, that matters immediately. If less metal leaves China, refiners and manufacturers in North America and Europe have to compete harder for what's left from other sources. Mine output in the Americas, scrap flows, and whatever inventories can be coaxed out of vaults. That additional competition shows up as tighter spot availability, higher premiums over futures in key hubs, and more pressure on COMEX to deliver real bars instead of just rolling paper contracts. The export choke is a geopolitical decision, but it lands as very simple math on the Western side of the ledger. Fewer tons available, more claimants. The data from within China confirms the severity of this internal shortage. According to figures compiled by Reuters and tracked by analysts like James Henry Anderson, the combined silver vault stocks at the Shanghai Futures Exchange and the Shanghai Gold Exchange have collapsed to a decade low. They currently sit at just 752 tons. Let that number sit for a moment. That is 24.2 million ounces. More critically, analysts calculate this represents a mere 5 weeks of industrial consumption for China. In other words, the nation's visible buffer is down to barely more than a single production cycle for its key industries. This forces a set of hard choices, and it brings the entire decoupling doctrine into sharp focus.
The decoupling doctrine is exactly this. A sovereign state stops taking its cues from the COMEX screen and instead manages metal based on local physical scarcity. As James Henry Anderson concludes, either silver trades much higher to bring in new inventory, or Chinese authorities are going to have to halt silver withdrawals soon. Read that as a sequence, not a movie script ending. First, authorities can ration withdrawals to the most strategic users, solar, EVs, defense, pushing less essential sectors to the back of the line. If that isn't enough, they can lean on imports, but that means outbidding other buyers, which requires a higher price to pull in marginal mine supply and scrap. The longer inventories sit at 5 weeks of cover, the more the system is forced towards some combination of stricter allocation, higher prices, and tighter controls on who actually gets metal. That is where the interaction with Western markets becomes critical. If China is hoarding and restricting exports while COMEX inventories are already draining, the paper price on its own can't fix the problem. You can keep the futures curve flat, but if physical is scarce, lease rates creep higher, short-dated contracts start to flirt with backwardation, and delivery windows stretch out. Those are the telltale signs professionals watch. Registered stock quietly stepping down, Chinese exchange inventories pinned at decade lows, export licenses shrinking, and yet the headline price pretending nothing is wrong. That configuration, a soft or stagnant paper price sitting on top of tightening physical availability, is the classic divergent setup that tells well-informed capital to accumulate metal and position ahead of delivery stress. So this is not random noise. It is a coordinated squeeze emerging from balance sheets and policy decisions, not press releases. On one side, COMEX is bleeding out registered bars into industrial demand and investor withdrawals. On the other, China is locking down its own dwindling stockpiles and prioritizing domestic industry over global supply. None of this has resolved in price yet. In fact, there is a clear historical precedent for this exact situation, executed by the most respected investor of our time. To truly understand the potential endgame, we need to look at what Warren Buffett did in 1997. Because he saw the same signals we see today, and his actions almost broke the market. What Buffett saw in 1997 wasn't the daily noise of the spot price. He was looking at a different dashboard, the professional's dashboard. And today, every light on that dashboard is flashing red, signaling a fundamental stress that the public price signal is designed to hide. First, let's examine the lease rate. This is, quite simply, the interest rate charged to borrow physical silver. For sophisticated players, it's a primary indicator of physical availability. Right now, the 1-month silver lease rate is near 3%. To put that into context, the 5-year average is negative 0.09%. Let that number sit for a moment. A rate that is normally negative, meaning it costs nothing to borrow, is now over 30 times its recent norm. This isn't a minor market fluctuation. This is the financial signature of a desperate behind-the-scenes scramble for physical metal. The second signal is even more direct. The market is in backwardation. This is a classic textbook sign of an acute physical shortage. It means the price for silver delivered right now is higher than the price for silver delivered in the future. Think of it like trying to buy a ticket for a sold-out concert. The price for a ticket tonight, right at the door, is far more expensive than a ticket for that same band's show 6 months from now. The market is paying a huge premium for silver now because there isn't enough to go around.
This is reflected in instruments like the 1-year silver swap rate, currently at 2.9973%, representing a staggering 7.2% total deviation from fair value. The entire silver forward curve is in backwardation. The market itself is screaming for supply. This exact method, ignoring a misleading paper price to focus on draining inventories and physical market stress, is how legendary investors identify massive opportunities. You are looking at the same signals a legendary value investor used to make one of his most famous commodity trades. In 1997, Warren Buffett saw that physical silver inventories were draining, while consumption outstripped production. His conclusion, stated directly in the Berkshire Hathaway annual letter, was that a higher price would be needed to establish equilibrium. So he acted. Berkshire Hathaway bought 129.7 million ounces of physical silver. He ignored the paper noise and followed the physical ounces, validating the precise analytical framework we are using today. Now, a logical question arises. With the recent sharp drops in the paper price, surely that has relieved some of this physical pressure, right? It's a reasonable assumption. But it reveals another dangerous misconception about how this market truly functions. The reality of what happened to physical demand during the price crash is counterintuitive, and it exposes just how deep the structural problem has become. The reality is that the 19% paper price crash did not alleviate physical pressure. It intensified it. This was a paper market mirage, a liquidation event in the futures market that had no connection to physical reality. While algorithms were selling paper contracts, the physical market indicators were screaming tightness. During the sell-off, COMEX registered inventory continued its relentless daily bleed, and silver lease rates, the financial signature of acute physical scarcity, remained at crisis levels. The paper and physical markets were operating in two separate dimensions. You will hear the argument that retail selling from ETFs put silver back on the market, easing the pressure. This reflects a fundamental misunderstanding of the mechanics. Let's be precise. The 42 million ounces sold from the SLV ETF provided no visible relief to the physical market. Why? Because retail investors sold paper shares. Simultaneously, institutional players and bullion banks absorbed that metal, taking physical delivery. On the COMEX, the net effect was a transfer of ownership from diffuse public hands into a few concentrated, stronger private hands. The market became tighter, not looser. Pause. We've just dismantled the paper market mirage. But the next two forces I'm about to show you are not about weekly fluctuations. They are locked in for the next decade. If you do not grasp how inelastic green energy demand and the broken mining cycle make this deficit permanent, the rest of this analysis is academic. First, the deficit is structural, driven by irreversible green energy policy. Demand for silver in photovoltaics, solar panels, is massive, growing, and completely inelastic to price. This isn't our opinion. This is according to the definitive industry report, the World Silver Survey from the Silver Institute. Solar demand now consumes approximately 70% of total global supply. This single factor is a primary driver of the market's structural deficit, which the Institute projects will be 95 million ounces for 2025. This demand is mandated by policy. It is not going away. Second, the supply side cannot respond. After a decade of underinvestment following the last price cycle, the mining industry is broken. Again, according to the World Silver Survey from the Silver Institute, global mine production remains approximately 7% below its 2016 peak. There is a thin pipeline of new projects. It takes 7 to 10 years to permit, fund, and build a significant new silver mine. Let that number sit with you. 7 to 10 years. This means that even if the price of silver were to triple tomorrow, it would not bring meaningful new supply online until the early 2030s. The deficits of today are already locking in the supply crisis for the rest of this decade. Physical silver, after all, does not grow on trees. So, the short-term price noise is a distraction. The long-term fundamentals, driven by immutable policy and geological realities, are locked in. We've now examined all 4 pillars of this market dislocation: the COMEX inventory drain, the strategic Eastern accumulation, the internal pressure gauges of the professional's dashboard, and now, the permanent long-term structural deficit. This completes our framework, the Decoupling Doctrine. In the final section, we will bring it all together. We will synthesize these 4 forces into a single, inescapable conclusion about what comes next. So let's synthesize everything we've mapped through the precise lens of the Decoupling Doctrine. We watched COMEX paper trade as usual while registered metal bled out against a wall of delivery demand. We saw China vacuum physical into strategic stockpiles even as the global benchmark price implied easy supply. On the professional's dashboard, lease rates jumped and time spreads slipped into backwardation, signaling strain in funding and near-term availability, while headline prices stayed calm. And over the long game, we traced a structural deficit locked in by inelastic industrial demand and mining lead times, measured in years, not months. Each of those is the same pattern: a calm paper surface over a physical market under stress. That pattern is the point. The Decoupling Doctrine simply formalizes it. When liquid paper markets broadcast stability, but the hard plumbing, vault inventories, shipment flows, lease rates, term structure, mine timelines, shows strain, you trust the plumbing. Metal wins, screens adjust later. Now add timing. Inventories and available float are bleeding today. We've watched COMEX stocks grind lower while contracts keep changing hands as if nothing has changed. The global bid from China and other accumulators is present today, pulling ounces into stronger hands. Industrial demand is locked in. Factories do not shut down because the chart looks inconvenient. And that 7 to 10 year mine development cycle we walked through does not suddenly compress because a futures curve demands it. That mismatch in clocks is the hinge. Physical tightness is a now problem. New supply is a later response. Holding the paper price down while those forces grind against each other doesn't resolve the stress, it stores it. Every month of suppressed pricing under structural deficit simply loads more pressure into the eventual adjustment. From there, the conclusion really is inescapable. The paper market, with its mechanically constrained price action, the time of day capping and pattern-driven sell programs we already mapped, tells one story. The physical market, with inventory drawdowns and growing delivery queues, tells the opposite story. They cannot both be right. One of these signals will be forced to move, and the data you've just followed says it will not be the metal that blinks. When that break finally comes, the correction is mechanical. Either prices gap higher to ration demand and pull metal out of hiding, or the paper market quietly changes the rules. More cash settlement, longer delays, a two-tier structure where real bars clear above the screen quote. Different paths, same destination. The gap between paper narrative and physical reality closes, fast in favor of scarcity. That is the inevitable correction embedded in the Decoupling Doctrine. You don't need a date, you need a framework. As long as inventories keep draining, industrial demand stays sticky and new mine supply sits years away. A subdued paper price is not reassurance.
It is a warning label. The sanitized version of this market is built to keep you staring at the benchmark price and ignoring that label. If you want the unsanitized feed, the vault reports, the lease rate spikes, the term structure flips, the delivery window math, stay with the data. Subscribe, turn on notifications, and treat this channel as one of your dashboards as we track how and when that pressure finally vents. The delivery window is coming. And when it arrives, you want to be aligned with the side of the market that has to deliver metal, not just promises.